The global financial crisis traces its roots back to the early 2000s, when interest rates in the United States, the Fed rate, were brought down to nearly 1%. This low interest rate environment encouraged excessive borrowing, particularly in the housing sector, as people took advantage of cheaper home loans. There exists an inverse relationship between interest rates and asset prices, so the economic outlook appeared promising. Banks aggressively expanded their balance sheets, seeking to capitalize on the booming housing market. Complex financial instruments like mortgage-backed securities provided banks with the liquidity needed to sustain this growth. Seeing the upward momentum in the mortgage market, other financial institutions also heavily invested in the securities. This led to deeper interlinkages between institutions and economies, creating a tightly woven global financial network. At this point, the procyclical effect came into play. The abundance of liquidity fueled economic overheating and rising inflation. In response, the Federal Reserve began raising interest rates. Higher rates triggered a sharp decline in property prices. The value of financial assets, especially securities, plummeted due to mark-to-market accounting, exposing significant valuation losses. What followed was a systemic risk event. Financial stability was severely compromised. Institutions across the interconnected network began suffering heavy losses. Some banks and financial institutions went bankrupt, and the contagion effect of this procyclical downturn triggered a global financial crisis.